Let's talk more about the quality of earnings, which is not strained so far, and whether we can continue to lift the markets. According to Barry Knapp, it's not anyway. Joining us for that, he is managing partner at Ironside Macroeconomics. Are you 80% sure we're bottoming in terms of all these metrics you look at? And you have a lot of numbers that you pay attention to.
I am.
Will you have a high degree of confidence?
I do have a high degree of confidence, for sure. Somewhere between 1 and 2 standard deviations, so 80 is about right, I guess.
About 80% sure that earnings have bottomed. And you point out, even more importantly, you can see it in revenue, which cynically you say companies can't game their revenues like they do with earnings. So that gives you even more confidence in that you're right.
No, that's right. I've focused on revenues for quite a long time because of earnings, gaming, and all. And so if you see revenues beating expectations by 100 basis points like they are this quarter, that shows you underlying organic demand is strong. The consumer discretionary sector is a great case in point. I mean, you've got 9% revenue growth in that sector. Amazon was an example of that, right? So they invested in same-day delivery, but their overall revenue growth was super robust. Even GE today, Honeywell, the industrial companies have all been reporting decent organic revenue growth with margin expansion, which to me tells you that that sector has made the adjustment to the tariff environment in the same way that they made the adjustment to the 2014 to 2016 25% increase in the trade-weighted dollar. So another one of these big shocks.
Well, I mean, Honeywell in particular, they produce locally. They have things that are local, so they aren't as affected by the trade talks and the tariff talks. Is this a momentary calm? Could it get worse if the trade talks get worse, or is this like the new normal?
Well, I mean, if the trade talks
walk the walk, talk the talk.
Right. If the trade talks and the trade negotiations were to deteriorate much further, and you had a shock that sent the whole global economy, including the U.S., in a recession, that would be a different story. But for me, it looks like, based on what's happened so far, you've made the adjustment. And when you think about the effects of trade policy, it's a big deal. It's a big drag on margins in China in particular. But in the U.S., not nearly as much. So the main channel that it worked through in terms of having an impact in the U.S. was the confidence channel. Mm-hmm. So you have a sort of a stock and a flow, right? The stock is the tariffs that are put in place. They're likely, assume they remain in place. That adjustment has been overcome. Unless there's additional tariffs, the confidence piece will normalize because of companies like that making the adjustment. So confidence starts to rebound. Capital investment should rebound alongside it, and then we move on from there. So I'm in the position of the view that unless things deteriorate further, we'll see that reacceleration.
Okay, so you say revenue growth, if it's 5% or above, allows margin expansion.
Correct. That's where you have operating.
But we're not at
5%.
We're close.
We're at 4, but we're only halfway through earnings season.
So
we're beating by 100 basis points, so we're going to be pretty close. And if we get that in the fourth quarter, if we get that recovery in business confidence and capital spending to tick up a little bit, then you get back to 5.
You think that the deregulatory environment that we've been in has also been sort of held back by tariff and confidence, and that will reassert itself, and that we're in pretty good shape?
The underlying trends from that are pretty robust. In particular, the banking sector is a great example of that, because you had return on equity capped at 10% for this entire business cycle until the fourth quarter of last year, when a lot of the regulatory loosening kicked in. It's now at 12. So the U.S. banking system is profitable. There's this uber focus on the yield curve, but the yield curve doesn't matter as much if you're growing assets, which they are, right? So there's an interesting dynamic going on with that as well, where you may have seen Mnuchin gave an interview yesterday, and he said, look, regulatory issues are, talk to Jamie Dimon, that is at the core of the repo problem. That's how they should be fixing it, not throwing $600 billion of QE at it. But we'll see.
So he's got, you weren't a math major, were you?
No, but son of a professor of electrical engineering.
Anyway, he points out that 10% level is crucial as a return on equity, because only then do you see things trade above book value, because they can earn their cost of capital.
That's right.
And where are we?
We're at 12.
So then that's good, too. So this is an inflection point, according to you.
Correct.
And what does that mean for the S&P?
Well, the rate, what really moves,
Is that why we're at new highs, or are we going to higher highs?
No, that is why we're at new highs.
The
rate of change of earnings growth is what matters for the multiple, not the level of growth, but the rate of change. So last year, growth was peaking. The multiple came under pressure despite strong earnings growth. This year, it's troughing and inflecting back up. That's why the multiple's expanding and the market's going higher. So unless something comes along to disrupt that, it's likely you'll see earnings growth stronger in the quarter, and the market will have already discounted it.
Even when the Fed says they're going to hold later. That's what I think is going to happen.
No, relax.
Hold on. You can say all of these things.
We got an inflection point and a new set. Okay, so we're here ready for some positive action, and more volatility.
But I think you're going to hear positive news. You're going to hear positive news from the Fed with the potential that maybe the guidance is less positive.
Not about the Fed.
Andrew, the rates aren't what matter.
The whole world is looking at
the rates aren't what matter. What caused the meltdown a year ago was globally synchronized QT. Right? You had the ECB cutting purchases. Fed, we went from $2 trillion of purchases in 2017 to zero in 18. It culminated in September and October. That's what caused the market to melt down.
Two kinds of people.
But
now the ECB, now the
Yeah.
ECB is buying again, and the Fed is about to pump $600 billion of reserves in the system with a banking system that's really working well. That money is not going to go just to fix the plumbing. It's going to work its way out into the system, likely loosen financial conditions. The dollar probably goes down as a result. That loosens trade credit, gets trade from Mexico to the U.S. going, and the whole global trade right should end. And the market's telling you that it's going to end. Yield curves are disinverting. Right. Autos are rallying in Japan and Germany. Sweden and Germany are outperforming the rest of Europe. This is all markets telling you the global trade recession is ending.
There are two kinds of people in the world. Those that blame the recent slowdown on the Fed being too tight or on Trump's trade wars. You think you are making the case that it's both, or that it's more the Fed being too tight? In the face of the trade wars?
In the fourth quarter of last year, it was global QT, not just the Fed, but the ECB and BOJ.
How many people don't buy that?
Right. My whole thesis this year was this was an echo of 1987. You had a series of events that were very similar to 87, and then in 88, the market spent the whole year recovering because the Fed responded to it. And you had a trade war going on, by the way, back then, too. I mean, Reagan put 100% tariffs on Japanese semiconductors in 1988, right? So same dynamic, and you just spent the year recovering from that. The trade war impaired business confidence for a time, but we're moving out of it.